This time, to prevent the Shanghai Composite Index from breaching the 3,000-point mark under pressure from Trump, the national team made a daily appearance punctually at 2:30 p.m., injecting hundreds of billions of yuan into the market. While the quip that China's stock market is perpetually at 3,000 points once embarrassed us, this defense of the 3,000-point mark has redeemed some pride, especially amidst the backdrop of the US stock, bond, currency triple slump. On Monday, April 7th, as the impact of the weekend's tariff news reverberated, the US share market opened with a sharp decline. Retail investors fled the market, fearing that the Shanghai Composite Index might plummet back to 2,600 points. However, a mysterious influx of capital began steadily buying large volumes of stocks. By the close of trading, the trading volume of a certain CSI 300 ETF soared to 24.3 billion yuan, a historic high and 6 times the previous day's volume. Novice investors panicked and sold without hesitation, but seasoned traders quickly recognized the signs. The national team had entered the fray. On that day, with the national team injecting over 69 billion yuan into the market, the Shanghai Composite managed to hold onto the crucial 3,000-point level. Late that night, in a building on Beijing's Financial Street, the lights burned bright. Its occupants were likely formulating strategies for the next day's market battle. Although no media reported on the meeting details or the identities of the attendees, it's reasonable to assume that the Central Hedge Investment Ltd, known as the National Team, was present. As a state-owned capital operation entity directly under the Ministry of Finance, Central Hedge holds stakes in more than 20 key financial institutions nationwide, boasting total assets of 7 trillion yuan, roughly equivalent to Saudi Arabia's annual GDP. Before the market opened on April 8th, Hedge publicly acknowledged its role as the national team, stating that it functioned like a stabilization fund. The People's Bank of China PBOC also pledged to provide ample funds to Hedge when necessary, essentially granting it an official mandate with unlimited resources. The joint public appearance of the PBOC and Hedge was a clear declaration. China would spare no effort to safeguard the stock market from collapse. On that day, the national team's buying spree intensified, injecting over 100 billion yuan into the market in a single day. The National Financial Regulatory Administration, accompanied by major insurance companies, also joined the fray by increasing their holdings in index funds. Retail investors watched in disbelief as it seemed like an armored convoy was crushing short sellers. Thanks to the national team's decisive actions and the injection of hundreds of billions of yuan over 2 days, the A share market finally broke free from the 3,000-point mark and started an upward trend. In the face of such a significant black swan event, China's stock market's unexpectedly stable performance was astonishing. In fact, financial institutions like Central Hedge have served as China's de facto stabilization fund since 2008. A stabilization fund, typically established by governments, is a type of securities investment fund designed to stabilize markets. During the devastating 2015 stock market crash, triggered by forced liquidations of off-exchange margin trading, the market faced a severe liquidity crisis. At that time, with less than 3,000 listed companies in Shanghai and Shenzhen on the worst hit day, 1,717 companies hit the limit and over 1,000 trading suspended. The market was paralyzed, with most stocks either halted or in free fall. Many trust collective investment plans linked to these stocks involved bank wealth management funds. If the market continued to decline, forcing further liquidations, trust companies would have been unable to repay bank funds. The lack of liquidity in the stock market then spilled over into the bond market as investors began selling bonds, threatening to collapse the interest rate system. Left unchecked, this liquidity crisis could have devastated the entire financial system. In such extreme market downturns, relying solely on market forces would lead to a self-perpetuating cycle of fall, sell-fall, especially when significant leverage was involved. The Bank of Japan has long supported its domestic market by purchasing a large amount of exchange-traded funds ETFs, now holding over 80% of domestic ETFs. South Korea also maintains a similar stock market stabilization fund. These examples illustrate how countries use state power to ensure financial market stability. Historically, China's national team has operated discreetly to avoid moral hazards and prevent individuals from exploiting insider information to profit against the market, as happened in 2015. However, this time, not only did it make massive purchases, but it also publicly declared its role as China's version of a stabilization fund, highlighting the gravity of the situation. Financial stability at this moment is a crucial bargaining chip in China's competition with the US. To understand the broader context, we must look at a figure increasingly in the spotlight: the US Treasury Secretary. As a key advisor to Trump and a former core member of George Soros' Quantum Fund, in the late 1970s, Europe established an exchange rate mechanism to reduce trade frictions. This system pegged currencies within a specified fluctuation range. By the early 1990s, the UK economy was in dire straits, suffering from soaring inflation and stagnant growth while maintaining its peg to the strong German mark. Soros' team identified a fatal flaw. If the UK raised interest rates to defend the exchange rate, its economy would collapse under the burden of high interest. If it cut rates to stimulate the economy, the pound would depreciate. Especially between 1985 and 1989, UK house prices doubled, depleting consumers' savings and saddling them with heavy debts, making them highly vulnerable to high interest rates. The Treasury Secretary, in charge of the operation, borrowed £15 billion equivalent to 3% of the UK's GDP and launched a massive sell-off. Coupled with a media campaign spreading panic about the pound's impending collapse, other institutions joined the sell-off, creating a herd effect. On September 16, 1992, known as Black Wednesday, the Bank of England desperately raised interest rates to 15% and spent $27 billion in foreign exchange reserves, more than China's total reserves of $20 billion at the time. Despite these efforts, the UK was forced to withdraw from the exchange rate mechanism, and the pound plunged 15% in a single day. Soros' team pocketed a $1 billion profit, catapulting the Treasury Secretary to fame. Now, as the US Treasury Secretary, there is reason to suspect that Name's hedge fund background is profoundly influencing US economic policies. He once publicly stated that tariffs are merely a tool, but he didn't elaborate on what kind of tool they are. Now, in his role as Treasury Secretary, is he looking to revive his old tactics and target the Chinese yuan? Is he trying to force China into a difficult choice between devaluing its currency and defending the yuan's exchange rate? Now, as the US Treasury Secretary, there is reason to suspect that Name's hedge fund background is profoundly influencing US economic policies. He once publicly stated that tariffs are merely a tool, but he didn't elaborate on what kind of tool they are. Now, in his role as Treasury Secretary, is he looking to revive his old tactics and target the Chinese yuan? Is he trying to force China into a difficult choice between devaluing its currency and defending the yuan's exchange rate? After Trump announced a 50% tariff on China on April 2nd, the offshore yuan rapidly depreciated to 7.43, hitting a 17-year low. Allowing the yuan to depreciate could offset the impact of tariffs on exports, but it might trigger a flood of capital outflows that could breach the financial dam. The memory of trillions of dollars fleeing during the 2015 stock market crash is still fresh. On the other hand, if China raises interest rates to stabilize the exchange rate, the already high real interest rates will weigh heavily on Chinese real estate companies, which carry a debt of 53 trillion yuan, and on the entire economy. Name likely assumes that China faces a similar dilemma, reminiscent of the combined housing bubble and exchange rate crisis that the UK endured. However, he may have overlooked one crucial point. Back then, when he directly confronted the Bank of England and shorted the pound unilaterally, the Bank of England had no leverage over him. This time, he is up against the People's Bank of China PBOC, which holds $3.2 trillion in foreign exchange reserves, including $750 billion in US Treasuries. Most importantly, he is no longer running a private enterprise where he only had to worry about his own interests. He now manages the entire US fiscal affairs. On April 9th, Name brought Trump some very bad news. US Treasuries were being massively sold off, and the yield on 10-year US Treasuries soared to around 4.5%. Many people mistakenly believe that the Federal Reserve can control interest rates because of its frequent announcements of rate hikes and cuts. In reality, the Fed can only manipulate short-term rates, not long-term ones. To simplify, the Federal Open Market Committee (FOMC) within the Fed influences the overnight lending rate, the federal funds rate, by buying and selling Treasury bonds with commercial banks. This is a typical short-term rate. For example, when the Fed sells Treasuries and withdraws dollars from the market, banks have less money, and the rate at which they lend to each other increases. But such operations have limited impact on long-term Treasury yields, like those of 10 or 30-year bonds, which are determined mainly by market supply and demand. The long-term Treasury yield serves as the benchmark for pricing all financial assets, significantly influencing economic operations and political decisions. If the selling of US Treasuries continues, long-term interest rates will rise even further, crushing the US economy and its $36 trillion national debt. Data shows that about $6.8 trillion in US Treasuries will mature in 2025. If the 10-year Treasury yield jumps from 4% to 5%, annual interest payments will increase by $80 billion. Mortgage rates could rise from 6% to 7%, increasing the monthly payment for a $3 million 30-year mortgage by $2,000. For a consumption-driven economy like the US, this would be a severe blow. In this situation, if the Fed chooses to accelerate rate cuts to stabilize the economy and the fiscal situation, it could lead to capital flight from the US. Japan, in particular, is an unpredictable factor. With Japan still raising interest rates, the narrowing interest rate differential between the US and Japan could trigger even larger scale selling of dollar-denominated assets. If the US decides not to cut rates to protect the dollar, it will harm employment and economic growth, potentially leading to a stagflation similar to that in the 1970s. In essence, the US is also caught in a. This is the real reason why Trump agreed to delay the tariffs for 90 days, to stabilize the US financial market. So far, although the Bank of Japan claims it hasn't sold US Treasuries, who would openly admit to such actions. Last August, Japan sold US Treasuries to drive down the yen exchange rate. At the time, then Finance Minister Name denied it, only to be later proven wrong by US Treasury Department data showing that Japan reduced its holdings of US Treasuries by $44.1 billion that month. Name also publicly stated that no country is selling US Treasuries, blaming Wall Street hedge funds that need to sell Treasuries to cover margin calls due to stock market losses. Wilder, leveraging on Wall Street is indeed a factor. This official narrative seems like a weak attempt to deflect blame, given the historical pattern. The more vehemently a sovereign entity denies a particular action, the more likely it is to be true. Under the US-led globalization system, other countries are tied to the dollar ship. In the complex web of the global currency system, exchange rate stabilization mechanisms involve intricate strategic games. To stabilize the yuan without issuing offshore central bank bills, the PBOC usually has to sell dollars and buy yuan. To obtain enough dollars for selling, it often needs to sell US Treasuries first. This chain of operations exposes the debt-binding nature of the dollar system. China's $1.27 trillion position in US Treasuries acts both as a strategic buffer and a sword of Damocles that restricts US financial hegemony. Therefore, it's reasonable to believe that China and the US are engaged in a game of chicken, with both waiting for the other to make the first move. Trump has been hinting that he's waiting for China to call, hoping China will take the initiative. But China, aware of the US's vulnerabilities, refuses to budge, leaving the situation at an impasse. At this stage, neither side can afford domestic unrest. The US's 90-day tariff delay is a tactical concession to gain strategic space for the Fed to cut rates and stabilize the Treasury market. China's injection of trillions of yuan into the share market by the national team is essentially about building bargaining chips. As the saying goes, tariffs are just a tool, and negotiation is inevitable. The US needs Chinese manufacturing to underpin the credibility of the dollar, while China needs the US market for industrial upgrading. This delicate interdependence means that while both sides test each other's limits, they must also maintain a modicum of rationality to avoid going over the edge. In the financial battlefield, the more stable a country's financial market, the stronger its bargaining position. Much like in a real world war, the victorious side holds the upper hand at the negotiation table. That's all for today's discussion. Thank you all for watching and for your likes and support.